Ever wondered if your favorite soda brand could be the golden ticket to a thriving investment portfolio? Let's talk about three titans: Coca-Cola, Pepsico, and Nestlé. Picture this. Reinvested dividends from these companies over decades could mean the difference between a humble nest egg and a financial empire. Intrigued? You should be. Let's kick off with Coca-Cola. It's been a staple in our refrigerators, but what about our portfolios? Coca-Cola's allure lies in its iconic brand and robust dividend history. Investors have often viewed it as a safe haven, especially in tumultuous markets. The company consistently distributes dividends, and when those get reinvested, your investment doesn't just grow, it compounds. Compounding is powerful. It's like a snowball gaining momentum down a hill, picking up more snow, and in this case, more money, as it rolls along. But let's not overlook the competition. Pepsico doesn't just pep you up with drinks, it brings snacks to the table too. This diversified portfolio helps PepsiCo withstand market volatility better than many peers, offering a stable dividend payout. So, can Pepsi's broad product base deliver a more satisfying return? Think about it. Now, shifting focus to PepsiCo. Its strength lies in diversity, not just sticking to beverages, but conquering the snack aisle with brands like Quaker and Lay's. This mix cushions the company against market headwinds. Ever notice how snacking doesn't really go out of style? Even in economic downturns, people crave comfort, a factor that bolsters PepsiCo's stability. Reinvesting dividends here means riding the wave of a stable, diversified portfolio, steadily gaining ground. On to Nestlé, the undisputed heavyweight of the global food scene. With a product range extending from baby foods to coffee, the sheer scope is staggering. Now, consider what that means for investors. A vast product spectrum guards against downturns in any single category. Their dividends are reinvested back into a company blueprint set on long-term growth. Imagine your dividends fueling innovation within divisions like health nutrition or plant-based products. But there's a twist. While reinvesting dividends sounds enticing, no investment is without risk. Changing consumer trends or increased health regulations could impact these giants. It's key to weigh these stocks' past performance and future potential as part of a balanced portfolio. So, are these stocks a fizzy boost to your investments or a flat addition? Time to decide what's worth a sip. When contemplating these stalwarts for long-term investment, diving into returns is crucial. Coca-Cola, often synonymous with stable dividends, may not boast explosive growth, but it provides reliability, an anchor during financial storms. Investors seeking steady income might find this comforting. But remember, as the market shifts to healthier choices, how will Coca-Cola adapt? Let's loop back to PepsiCo. Aside from brand diversity, they've made strides in health-conscious offerings. With initiatives to reduce sugar content and expand nutritious product lines, they're not just resting on past victories, but evolving alongside consumer preferences. It's about legacy balancing with innovation. Those reinvested dividends could be funding the next big health snack. And now, a closer look at Nestlé. They're keen on sustainability and health trends, two powerful forces driving the market today. From reducing environmental footprints to expanding organic options, Nestlé's long-term strategy aligns with growing consumer awareness. Investing dividends here could mean being part of a purpose-driven growth trajectory. Ultimately, whether Coca-Cola, PepsiCo, or Nestlé fits your portfolio depends on your investment goals. Seeking stability, diversity, or global reach? It's your call to action. It's time for a sip, not only to quench thirst, but to invest wisely. Delving into the intricacies of these giants' financials offers a deeper understanding of their potential in any portfolio. Coca-Cola, for instance, operates on the philosophy of think global, act local. Their expansive reach across international markets provides a buffer against localized economic slumps. Reinvesting dividends here isn't just about capital growth. It's about tapping into that worldwide cola-loving culture. PepsiCo's financial fabric weaves in strategic acquisitions and partnerships, continually expanding their brand matrix. This not only solidifies their market position, but also opens doors to new growth channels. Think proteins from new plant-based partnerships or innovations in low-calorie snacks. That's where those reinvested dividends might pay off, fueling future forward projects that could redefine snacking as we know it. Nestlé stands as a testament to robust management and strategic vision. Their penetration into emerging markets, especially in Asia and Africa, showcases their drive to capture burgeoning consumer bases. Investments here aren't just tied to current market value, but also the untapped potential these regions represent. Reinvestment means backing a company that's strategically positioning for tomorrow's opportunities today. In this dynamic investment landscape, each of these companies offers its unique flavor of potential. It's not just about financial metrics, but also aligning with your investment ethos and long-term vision. Whether you sip, snack, or stir, consider how each contributes to a diversified and promising portfolio journey. Ultimately, you'll want to assess how each of these titans can serve your unique investment goals. Coca-Cola, with its storied legacy and expansive reach, offers stability that can anchor your portfolio, especially if you're someone who prizes consistent dividend returns. But the real question is, in a world shifting towards healthier beverages, how will Coca-Cola innovate beyond its classic lineup? Meanwhile, PepsiCo's versatility positions it as a dynamic powerhouse. It's not just a beverage company, it's embedded in diverse consumer habits, from drinks to snacks. Reinvesting dividends here might just mean you're backing a company that blends traditional appeal with forward-thinking adaptability. Imagine being on the front line as they roll out the next big dietary breakthrough. Nestlé, on the other hand, is like the Swiss Army knife of stocks, a versatile investment with fingers in countless pies. This makes it appealing for those interested in gaining exposure to global markets, from developed economies to fast-developing regions. Your reinvested dividends could be nurturing innovations aimed at sustainable and health-conscious living, tapping into trends with longevity. As we wind down, think about this. It's your portfolio. Whether you're driven by the security of a well-known brand, the excitement of diversification, or the promise of global business strategies, these options offer flavors to satisfy every investor's palate. Ready to toast to potential gains? The choice is yours. We've explored the distinctive attributes that Coca-Cola, Pepsico, and Nestlé bring to the table, each offering unique pathways to potential prosperity. Whether it's Coca-Cola's enduring reputation, PepsiCo's adaptive diversification, or Nestlé's expansive global reach, these giants provide diverse opportunities to enhance your portfolio with reinvested dividends. Now, it's your turn to decide. Dive deeper into their strategies, align them with your financial objectives, and consider how they can fit into your long-term investment vision. If you're ready to take the next step, explore more about these companies and get their stock performance updates by subscribing to our channel. You'll stay informed and empowered to make savvy investment decisions. Remember, every investment choice is a step toward your financial future. Cheers to making informed, strategic choices.